Hey guys, in this video I'm going to be showing you a trading strategy that many traders use, and that is trading trend continuation pullbacks. I'm going to be providing you with a set of rules for trading that strategy, and I'm also going to be showing you how you can limit your risk while increasing your profit potential. Just to make you aware, Forex trading is very risky. 75 to 90% of retail traders lose money when trading Forex. So you should consider whether you understand how CFDs and leverage trading work and whether you can afford the high risk of losing money. Any information discussed here is solely for educational purposes and you should not consider it investment advice. So with that said, I want to quickly show you what a pullback is. Many traders do know what pullbacks are, but for those of you that don't, it's very simple to identify a pullback on your chart. So it's basically a temporary reversal or pause in the prevailing trend of a financial asset's price. And it basically occurs when the price moves against the trend for a short period before resuming its original direction. Now, why do pullbacks occur? Well, they happen for several different reasons. The first reason is for profit taking. So traders who bought the assets at lower prices may sell to lock in profits, for example, and this leads to a temporary decrease in demand. Then it also happens due to market sentiment shifts. What I mean by this is that some market participants may anticipate a trend reversal and initiate trades in the opposite direction. And lastly, it occurs because traders think that the asset is overbought or oversold. So technical indicators might suggest that an asset is overbought or oversold, and this prompts traders to take opposite positions temporarily. So no matter what the reason for these pullbacks, you will notice that they occur across all asset classes and across all time frames. And what they are is an opportunity to get in the market at a slightly better price. So for example, during an uptrend, buying at the bottom of these pullbacks will provide excellent trading opportunities. And to trade the pullback successfully, we look for an identifiable trend, like you can see here, in this case an uptrend, with clear higher highs and higher lows. We wait for the pullback and then identify the point where buyers regain control. And this approach gives us the best odds for profitable trades. Before we jump in, I just want to show you some mistakes that traders make, and they're very easy to make, but they're also very easy to avoid if you know what to look out for. Number one is that they enter the trade without a clear identifiable trend. If you are trading an uptrend, you want to ensure that there's a new high before entering a pullback trade. And as you can see in this example, this was an uptrend, but then price started ranging and thereafter actually reversed and began trending downwards. The second mistake is that they enter the trade too early. So you want to avoid entering trades during shallow pullbacks without additional confluences, such as significant price levels or moving averages. And as you can see on this example, there wasn't enough evidence that the pullback actually was going to occur. And the third mistake is lack of confirmation. And this is something I harp on about a lot. You want to see a confluence before you enter your trade. And you should not enter a trade without confirmation that buyers or sellers are taking control. For example, in a downtrend, you'll look for a significant bearish candle to confirm seller's control, or you'll look for a bullish candle or set of candles to confirm the buyer's control, as you can see here. Now that we've looked at those mistakes, I want to provide the rules that you can follow to hopefully trade pullbacks successfully. Here we have the New Zealand dollar, US dollar, or the Kiwi, and as you can see, it's a clear uptrend. You can see the higher highs and higher lows, and it appears that a pullback is about to occur. So the trend starts to move slightly in the opposite direction. You'll then see that price moves to the 50 EMA and you have a green candle that closes above the previous green candle. And then the price moves up in the direction of the trend. Now, before you take any trade, you need certain conditions that need to be met. So firstly, you need to find the confluences that make that trade valid, which I'm going to show you now. You need to find a trigger to enter the trade. You then need to find your stop loss point, and then you need to find a target or a take profit point. So let's start with the conditions. And as I said earlier, the market needs to be in a clear trend. So you need to find higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. Next, you want to find a pullback that reaches a significant structure level or a level of support and resistance, and it needs to be close to the 50 EMA. So as you can see here, the pullback reaches a significant level of structure or level of support and touches the 50 EMA. Then you'll look for a candlestick pattern that indicates control, either by the bulls or the bears, in this case by the bulls. And this would be a bullish candle closing above the last red candle, or a series of green candles that close above the last red candle. And that's what you can see here too. So the trade here shows a confirmed uptrend, a pullback reaching the 50 EMA and a level of structure, and the second bullish candle closing above the red candle's high. And this setup provided a high probability trade which hit the target at a 2-to-1 risk-reward ratio. I want to show you another example. This time I'm going to be showing you a chart of the Euro USD. So here we have an identifiable downtrend with lower highs and lower lows. You then have a pullback reaching a previous structure level and the 50 EMA. You also have confirmation of the sellers taking control with the large red candle going below the low of the previous green candle. This setup basically met all our criteria and the trade was executed successfully. So in short, there are 3 criteria. You want the presence of a clear trend. 2, you want the price pulling back to the 50 EMA with the addition of a clear level of structure, either support or resistance, depending on whether it's an uptrend or a downtrend. And then you want a clear control signal, either the bears or the bulls taking control, which means that there are clear large red or green candlesticks in play. Now, in closing, please ensure that you go and backtest this strategy. Try it out on the currency pair or the asset that you trade and ensure that you try it out on the time frame that you generally trade with. As always, manage your risk. Ensure that you always have a stop loss in place and that you have a profit target in place. And when you do set these up, that you use the right risk to reward ratio. Thank you so much for watching. If you have any questions, as always, please don't hesitate to contact us. Our website is fxscouts.com. And please remember to subscribe and like.